Banks just reduced derivatives credit exposure by $37 billion in 9 months, while total notional amounts increased by $32 trillion. That contradiction tells you everything. They're increasing positions but decreasing risk. They're preparing for something. And CME is preparing too. 5 margin increases in 60 days. December 12th, 19th, 29th, 31st, February 2nd. Then on January 13th, CME changed the entire margin calculation methodology, switched from fixed dollar amounts to percentage-based requirements. The kind of change you make when you expect extreme volatility that breaks traditional models. This isn't random. This is coordinated preparation across derivatives infrastructure. Banks reducing exposure. CME raising margins. Both signal the system is preparing for stress retail investors don't see coming. Let me show you the data that proves institutions are quietly de-risking while markets hit records. Start with OCC Bank Derivatives Report because these numbers are buried in regulatory filings most people never read. Q1 2025, Office of Comptroller of Currency releases quarterly derivatives data. Net current credit exposure for U.S. banks decreased $21.3 billion, down 7.9% to $249 billion. But here's the contradiction that reveals the strategy. Total derivatives notional amounts increased $23.9 trillion, up 12.8% to $210.4 trillion. Banks are trading more derivatives than ever, expanding positions, but reducing actual credit exposure significantly. How? By restructuring positions to reduce counterparty risk, by increasing collateralization, by shifting to centrally cleared contracts, by preparing portfolios for stress. Q3 2025, the pattern continues. Net current credit exposure decreased another $15.8 billion, down 5.9%. Total derivatives notional increased $8.3 trillion, up 3.7% to a record $231.8 trillion. Over 9 months, banks reduced credit exposure by approximately $37 billion, while expanding notional positions by over $32 trillion. The divergence is unprecedented and intentional. This is sophisticated risk management. Banks aren't exiting derivatives markets, they're repositioning for crisis, maintaining upside exposure through notional amounts, but eliminating downside risk through credit exposure reduction. It's the institutional version of buying insurance before the hurricane hits. Now look at what CME is doing simultaneously. December 12th, 2025, CME raises silver futures margins 10%, from $20,000 initial and maintenance to $22,000. Official reason, normal review of market volatility to ensure adequate collateral coverage. Translation, silver volatility is increasing and current margins aren't sufficient to cover potential losses. December 19th, equity and metal margin increases, multiple products affected. December 29th, another round of metal margin increases. December 31st, year-end metal margin adjustment. 4 margin increases in 19 days. This isn't normal. Exchanges don't raise margins this frequently unless they're seeing warning signals in their risk models. Then January 13th, 2026, CME makes the big move. Changes the entire margin methodology for precious metals. Previously, margins were fixed dollar amounts, $22,000 per contract. Simple, predictable, but fixed dollar margins break when prices move violently. If gold goes from $4,000 to $6,000, a $22,000 margin that was adequate at $4,000 becomes insufficient at $6,000. So CME switched to percentage-based margins. Gold futures now require 5% of contract value. Silver and platinum, 9%. Palladium, 11%. This methodology scales automatically with price. As prices rise, margin requirements rise proportionally. As prices fall, margins fall. It's the system you implement when you expect price volatility to exceed historical models. February 2nd, another metal margin increase under the new percentage system. 5 margin adjustments in 60 days. The frequency tells you CME is responding to risk metrics that are flashing red. Their models are projecting volatility that requires continuous margin increases to maintain adequate collateral coverage. Why does this matter? Because margin increases reduce leverage. When margin requirements double, the amount of capital needed to hold positions doubles. Traders who can't post additional margin get liquidated. Positions close, open interest decreases, liquidity declines, margin increases are deflationary for derivatives markets. CME is deliberately reducing system leverage. Now let me show you what banks are actually doing with their derivatives positions. The OCC data breaks down exposure by asset class. Interest rate derivatives represent $141 trillion notional, 67% of total bank derivatives. These are the contracts banks use to hedge bond portfolios and manage duration risk. Credit exposure from these contracts is declining even as notional increases. Foreign exchange derivatives, $37 trillion notional. Credit exposure declining. Equity derivatives, $22 trillion notional. Credit exposure declining. The pattern holds across every asset class. Banks are restructuring positions to maintain market exposure while eliminating counterparty risk. How? Through central clearing. When banks trade OTC derivatives bilaterally, counterparty A faces credit risk from counterparty B. If B defaults, A loses. But when derivatives clear through CME or other clearinghouses, the clearinghouse sits in the middle. A faces the clearinghouse. B faces the clearinghouse. The clearinghouse guarantees both sides. Counterparty risk transfers to a systemically important institution with strong capital buffers. Banks are shifting trillions from bilateral OTC to centrally cleared. The OCC data shows this explicitly. Netting benefits, the reduction in exposure from offsetting positions, increased 88.4% in Q1 2025. That's $1.9 trillion in exposure eliminated through netting. Banks are consolidating positions, standardizing contracts, moving to exchanges, all risk reduction activities. Level 3 assets tell another story. These are positions that can't be valued using observable market inputs. Banks use internal models to price them, highly opaque, high risk. Q1 2025, banks held $34 billion in Level 3 trading assets, down 8.2% year over year, down 83.5% from 2008 peak of $204 billion. Banks are systematically eliminating hard-to-value positions. This is crisis preparation. The last time banks aggressively reduced Level 3 assets was 2008-2009. Lehman collapse taught banks that opaque positions become worthless in crisis. If you can't value it with market prices, you can't sell it when you need liquidity. Banks learned they're not holding complex illiquid derivatives into the next crisis. Now combine the bank data with CME actions. Banks reducing credit exposure by $37 billion. CME raising margins 5 times in 60 days. Both institutions are de-risking simultaneously. This isn't coincidence. Both are responding to the same underlying signals, volatility, models, projecting extreme moves, correlation breakdowns, tail risk increasing. What are they seeing? Start with precious metals. Gold rallied 65% in 2025, silver doubled, platinum surged, palladium up 76%. These aren't normal moves. These are crisis moves. The kind of price action you see when investors are fleeing currency risk, anticipating inflation, hedging systemic failure. CME's margin increases reflect this. Gold at 5% margin means CME expects potential daily moves of 5% or more. But precious metals are symptom, not cause. The real risk is in interest rate derivatives, $141 trillion notional, 67% of bank derivatives. These positions hedge bond portfolios. If bond markets become disorderly, if yields spike unexpectedly, if correlations break down, interest rate derivatives face massive losses. Banks reducing credit exposure here signals concern about bond market stability. Treasury market is showing stress. Volatility increased throughout 2025. Dealer positioning constrained. Fed balance sheet unwinding removes liquidity. Foreign demand questionable with strong dollar, term premium rising. All signals that bond market stress is building. Banks see this in their treasury trading desks. They're reducing derivatives exposure preemptively. Commercial real estate derivatives are another risk pocket. Banks have exposure to commercial real estate through both direct loans and derivatives hedging those loans. Office buildings down 30 to 50% in value. Refinancing wave hitting 2025-2026. Banks are reducing exposure to real estate derivatives because they know losses are coming and don't want counterparty exposure when stress hits. Corporate credit derivatives. Banks hedge corporate loan exposure through credit default swaps. But if economic slowdown materializes, if SARM rule triggers at 0.50, if unemployment rises, corporate defaults increase. CDS contracts pay out, counterparty risk spikes. Banks are reducing this exposure now before defaults accelerate. Here's what you need to understand. When banks reduce derivatives credit exposure while maintaining notional positions, they're telling you they expect counterparty defaults. They're restructuring to eliminate bilateral risk. They're moving to central clearing. They're reducing complex positions. These are the actions you take before crisis, not after. When CME raises margins 5 times in 60 days and changes calculation methodology, they're telling you volatility models are projecting moves that exceed historical norms. They're preparing the system for stress. They're reducing leverage preemptively. They're making sure clearinghouse has adequate resources to cover defaults. The timing matters. This acceleration happened Q4 2025 into Q1 2026, the same period when billionaires sold aggressively, Buffett holding $325 billion cash. Bezos liquidated $8.5 billion. Gates reduced Microsoft 55%. Diamond first sale in 19 years. Insider selling ratio 4.7 to 1. These aren't separate stories. This is coordinated de-risking across institutional landscape. Banks reducing credit exposure, CME raising margins, billionaires selling, all happening simultaneously in Q4 2025 and Q1 2026. All pointing to the same conclusion. Institutions with best information are preparing for crisis they see coming. Now let me show you what retail is doing. Nothing. Retail investors are buying stocks at record valuations. Crypto near highs. Real estate still elevated. Retail derivatives participation increasing. CME reported record retail futures volumes. Micro contracts up 59% in Q4 2025. Retail is leveraging up while institutions are leveraging down. This is the classic late cycle dynamic. Smart money exits, dumb money enters. Institutions reduce risk, retail increases risk. The wealth transfer mechanism activates, and when crisis hits, retail gets liquidated on margin calls while institutions, safely positioned in cash and low-risk positions, deploy capital to buy assets at distressed prices. The OCC data proves institutions are preparing. $37 billion credit exposure reduction over 9 months. Level 3 assets down 8.2%. Netting benefits up 80%. Central clearing increasing. These are systematic risk reduction activities that accelerate before crisis. CME margin increases prove the system is preparing. 5 increases in 60 days. Methodology change from fixed dollar to percentage-based. These are defensive actions that reduce system leverage and prepare for extreme volatility. The question isn't whether crisis is coming. Institutions have already decided it's coming. They're positioned. The question is whether you'll recognize the signals and position accordingly, or whether you'll ignore the data and hold risk into the downturn. What should you do? First, reduce derivatives exposure. If you trade futures, options, any leverage products, understand that margin requirements can double with little notice. CME just demonstrated this. 5 increases in 60 days. Your positions could face forced liquidation if you can't post additional margin. Second, reduce counterparty exposure. If you hold OTC derivatives with bilateral counterparties, move to centrally cleared where possible. Banks are doing this for a reason. Counterparty risk is real and increasing. Third, reduce portfolio leverage generally. Institutions are deleveraging, banks reducing credit exposure, CME raising margins. Both actions reduce system leverage. Follow them, hold more cash, reduce margin debt, eliminate speculative positions. Fourth, watch for acceleration. Banks reduced $37 billion over 9 months. If next quarter shows $20-30 billion reduction, the pace is accelerating. That signals crisis timeline shortening. CME raised margins 5 times in 60 days. If they raise again in the next 30 days, volatility is exceeding their models. Both metrics provide early warning. Fifth, recognize this as institutional preparation. When banks and exchanges are taking defensive action simultaneously, they're not wrong. They have information you don't have. They see risks you can't see. They're preparing for outcomes they consider probable. Banks reduced $37 billion derivatives credit exposure while expanding notional by $32 trillion. CME raised margins 5 times in 60 days. These aren't random events. This is coordinated preparation for crisis. The institutions that survived 2008 are preparing for whatever's coming next. And their actions tell you they expect it soon. The data is public. The OCC reports are available. The CME margin notices are posted. The information is there for anyone who looks. But most people don't look. Most people trust that markets will continue, that institutions aren't preparing for crisis, that current conditions are sustainable. The institutions preparing for crisis disagree, and they have the information to make informed decisions. The question is whether you'll pay attention to what they're doing or whether you'll listen to what they're saying, because what they're doing is preparing, and what they're saying is everything is fine.